Good morning. Uh, my name is Ruggiero Lo Monaco. I'm the head of real estate funds for Rajmala Investment Bank. Today is the 24th of October, 9:27 in Dubai. Today, I would like to share with you some research that I was doing during the weekend. So, first of all, I um, was researching and putting together some numbers on what would be an appropriate expected rate of return for real estate in the UK, USA, and Germany, or let's say the European Union. Over the last few weeks, there has been a lot of talks about the impact of rising interest rates on property valuations, rightly so. Uh, but I continue to see references to the cap rates being below interest rates or very close to interest rates as the primary reason of why the property market should correct. So I wanted to break down really the cap rates and the total expected return of a property, which is basically the discount rate used to value the cash flows of a property. Just to clarify, what is the reason, potential reason of downside pressure on property valuations? So let's read together this table. So first of all, I have taken the 10-year government bonds for the UK, USA, and Germany. But then I subtracted from those 10 years the 10-year inflation swap rate. Why? Because I want to see the real rate of return. If you remember economics, in economy, it always the equilibrium models relate to the real rate, which is the nominal rate less the inflation, because that is the real determinant of the return or the cap rate of real estate. We cannot compare the cap rate or the rental yield of a property with just simply with the bond yield or deposit rates, because in one case you have a nominal yield. I mean, the bond gives you a fixed coupon and the capital at maturity. If there is inflation, that inflation just eats inside the capital. Just ask anybody who had the deposit in 1970 what is the worth in today's purchasing power of that deposit today. The rate of a property is a real yield. Why? Because the properties, so first of all, the income of that property or the rent of the property should increase over time as the rent increases with inflation, and secondly, because the value of the property increases. So when we want to compare, when we want the cap rate with the interest rates, the comparison should be with the real rate. Okay, so what really it has to be added to the uh, property, so to the cap rate or to the real yield to determine the cap rate is the property risk premium, which typically varies between 2 and 3%. I've used just a mid-range here of 2.5%, and the liquidity premium of 1 to 3%, 1 to 2%. So typically that is the range where this liquidity premium is. And this is how, by adding now real rate, risk premium, and liquidity premium, we obtain the cap rate. So the cap rate can increase, okay, and that can bring down the property valuation. First of all, if the real rate increases, and it has increased, certainly it has increased. They were negative. I mean, in Germany, it's still negative, but right now they are positive. So that certainly has a downward impact on the valuation of properties. The property risk premium is really can increase. Yes, if there is a recession, if there is doubt about tenants paying their rents, the overall demand of a certain property like shopping center, that can increase. And the liquidity premium can also increase. I mean, just think about what happened in the great financial crisis, where the debt markets froze and it became very difficult to sell properties and to finance those properties. So it can increase. So these are the real source of risk uh, for real estate. As far as the nominal yields of interest, well, they are increasing because inflation is increasing. Okay, so when we add back that inflation, we add it back here to determine by adding the inflation as a proxy of the growth. Why? Because we just make an assumption that rents over time increase with inflation. That gives us an expected total return of the property: 8.3 for the UK, 8.21 for USA, 6.42 for Germany. Then we adjust those returns for the interest rate differentials, and we have a common currency type of expected returns. So the conclusion that I reach when I look at this chart is that yes, it is possible, and probably it will happen, that the property value will decline over the next few months. But today, if I were to decide to invest in fixed income of real estate, I cannot just compare the cap rate with the interest rates, because the properties are priced to deliver a premium and over and above the interest rates. So if an investor is looking for a return higher than inflation, it needs to take risk. It needs to attempt to generate a return higher than the risk-free government bond yields. Similarly, I was then looking at the history of this recent history of this real yields, and I found some research. Literally, it landed in my inbox this morning from Alpine Macro. Okay, here they analyze. Indeed, they were analyzing the real bond yields. Okay, and what they noticed is that indeed the yields have become positive at some point during the year because of aggressive tightening of the central bank, and that, in their opinion, has caused an overshoot of the real bond yields, because in their opinion and their research, the deflationary forces in the economy, specifically they mentioned the aging population, are still at play. And over the course of the 6 to 12 months, according to them, the central scenario is that tightening will reduce, and because inflation will come down and real bonds, real yields will come down. So their central scenario is for a bullish call at this point of the cycle. Similarly, they were looking at the interest rates. They said the US, the 10-year Treasury yield and the generic 8 euro dollar contract yield have been moving in lockstep because the central bank has been guiding the markets that way. And as a result of that, as soon as the, the, the short-term rates start coming down, the long-term rates will come down as well. Now here, just to conclude, I wanted to show you the inflation swap curves. These are three snapshots which I've taken from Bloomberg. One for the United States, one for Great Britain, and the other for the European Union. So what is this? This is basically the fixed return that an investor has to say pay in order to receive a return equal to the inflation. So it's an expectation of the average inflation over 1 year, over 2 years, over 3 years, and so forth. Okay, so when I was calculating the real yield, I went to use the 10-year, which is I compared to the US Treasury yield, to the gilts, and the German bonds. So as you can see, already within a year in the US, the market is pricing an inflation of 3%. Now, the swap curve is not a reliable, very reliable indicator of what actually inflation will be. But that is what the market is expecting. Market can be wrong, but that is what is expecting. Situation is different for the UK, where really inflation is priced to remain very high. So 9% 1 year, 6% averaging over the next 2 years, and over the next 10 years is expected to average of 4.19%. If I use that inflation as a proxy of the growth of the UK real estate, I find very attractive, especially investing in long income assets with inflation linkage. A situation is different in the European Union, where inflation is going to be pretty much in line, expected to be by the market, pretty much in line with the euro, with the US, okay, and certainly lower than the UK. So, final couple of slides. This one is from Jeffries, the chief economist, and it shows the direction of policy rates of Fed funds currently priced in the market, which is this green line. Which is expected to go up to around 5% early next year and almost immediately start going down to 3.5%. Then there is the red dotted line is the medium expectation of the policymakers, and their expectation of Jeffries, which expects interest rates to go slightly higher than both the market and the policymakers expect, but then fall precipitously. In their opinion, in the opinion of Jeffries, the economy just can't sustain these high interest rates. And indeed, over the course of last week, we have seen some Fed policymakers mentioning that there is a need of of being cautious in continuing with this aggressive policy tightening, because things can happen. We have already seen what happened to the gilt market, and last week the Bank of Japan had to intervene to defend the yen. These high interest rates are upsetting the equilibrium of the markets because they are essentially attracting liquidity away from all over the world to the US, and from the US pretty much back to the central bank. Finally, this interesting chart from Jeffries, showing the impact of the Fed funds and dollar on year-over-year GDP growth. What Jeffrey does is to add the impact of the Fed funds to the impact of the dollar, because a strong dollar has a tightening effect on the US economy. First of all, it lowers the cost of import, okay, but it also reduces the revenues that the exporters make when they sell overseas. So according to this model, by the end of 2022, the economy should enter in a contraction mode. And by the end of 2023, it will have contracted by about 2.5%. So the impact of the Fed funds would be a contraction of 2%. The dollar seems to add an extra 50 basis points. So, in conclusion, I would say that for the next 3 to 6 months, it's a good practice to be cautious, okay? Because most probably a number of real estate asset classes will correct. But at the same time, I would say not to discard the risky assets, real estate, high yield bonds, equities, all together from a portfolio, just to take advantage of the high yields offered by deposits and fixed income investment grade bonds, because these are assets that generate a nominal return. Their capital is not linked to inflation, and if inflation indeed persists at this high level over time, they will generate a suboptimal rate of returns, in the sense that investors will receive a coupon, but the capital will lose purchasing power. Even in a high interest rate environment, we need to try to generate a premium over and above the risk-free rates and over and above the investment grade bonds, because this interest rate environment is determined by inflation. Okay, so the real nominal yield, the real yield embedded into these fixed income instruments is negligible. Thank you very much.